Greetings, market rebels. Welcome to this week's macro measure. It is Monday, May 29th, 2023, Memorial Day. It's a little bit after 10:30 a.m. here on the East Coast. Let's get into the disclaimer and get that covered. And let's get into our trustee intellectual property rights notice and get that covered. And now we can go into the planned program, and I'll leave that up there in case anyone wants to take a screenshot while I'm talking, but we'll get into all these. I'll position this off screen. We'll go through all of these. This will be a relatively short, I think, video compared to the usual droning on thing that I do, but probably better that way at the moment anyway. But yeah, just because we've got newsletters that we're about to get to that have to go out later today due to the holiday weekend. But first and foremost, before I start shifting everything around, let's give a thanks to all those vets, a sincere thanks to all those vets past and present this Memorial Day for their sacrifices on the country's behalf. And with that, I'm going to rearrange things. So just bear with me, please, for a moment. Let me go over here. And I should be able to get my main screen rolling here. Okay, so here's my main screen, and we'll get into all these things. It's probably fitting that I left it on the QQQs. Those are the SMH, would have been probably the most fitting, but let's kind of go through where we are right now. So, and then we'll get into more things. I'm just going to do this in order to make sure this thing flows properly and we get through it, just because I've got so much work to do on these newsletters. Anyway, as many of you recall, we've been in a trading range. We had been in, a trading range for some time. It was kind of frustrating, but then we finally got out of that really in earnest the week prior. Or a week and a half prior to that. And then we had this pullback, right, at two really kind of near that those breakout highs. So once again, the old potentially converting former resistance to support. And of course, that worked like a charm because of the NVDA earnings. Now, as we're going through the planned program stream, they tacked on a lot. It was mainly, right, again, in tech and especially in the semis. We did begin to discuss NVIDIA a few weeks back. We were trying to latch onto what could be the driver for the next potential upswing in this market, right? Because a lot of obvious things that they'd normally be able to use were not there any longer, right? But that turned out to be a decent hunch that they were going to use the AI, the NVIDIA, that whole EPS pre-run and then the EPS reaction potentially if NVIDIA made it possible. And that certainly is what happened. You can never know for sure, right, when you start to come up with what's their most likely next move. But in this case, it turned out to be that was really, I think, it. And the other side of this, though, is that things are extremely extended in the short run. I'll try to cover all these. Hopefully I'll remember to cover all of these before we close things out here on macro measure. But just to give you a sense of what I'm talking about, the RSI on the 4-hour in the Qs is 76 if I round it. If you drop down to the 30-minute, it is 78. If you jump up from there to the 2-hour, it is 76. So this is very short-term overbought, and it's still kind of narrow, but that's been the case, right? So we'll talk more about things like that. The recent strength ratings that we've discussed with the Qs, followed by the SPYs, followed by the diamonds and IWM, that kind of held intact again, where what was showing you strength continued to show you strength, and what hasn't been did not, right? And that's one reason why we go through all these things and the sectors to try to see what's going on, right? Where maybe the action is, what's the status, what's possibly going to happen next. Obviously, right, this stuff is challenging, right? Each week brings different challenges and different types of market action. And the longer you stick around in this game, the more you realize there's still a lot to learn, even if you see a lot of the same things over and over and over again in slightly different ways that they manifest themselves. But regardless, I do have a comment here about the narrow participation. Now, I saw some Twitter luminaries saying, no, that's not the case. And they're trying to make this case that this big tech push, there's a lot more good stuff accompanying it. One way that you could look and say, well, what's going on would be maybe something like this, right? Where you say, well, and we're using the market rebellion embedded chart tool here. Well, how many stocks are moving above their 20 SMA, right? And this is not all that impressive, right? If there's been this great start to things, you'd expect to see more stocks moving above their 20, above the 50, above the 200 potentially. And if you look at all three of these, here's your 200, right? And I'll go back on the other ones to the 50, and you go back to the 20. It's just not there. I just don't often disagree with people, but I think some of these perma people just eventually, like, you see their tweets pop up and you're just like, come on, guys, like, deviate from that story, your constant story here and there. Show me that you're just not locked into a mentality that you refuse to leave regardless. You refuse to abandon regardless of what comes our way. You're always trying to spin it a certain way. I don't understand it, frankly. If you've been around the markets for any length of time, you know that the markets are very dynamic. They're puzzling at times if you try to make sense out of them, which again is why we discard that in the short run, really, and try to really focus mainly on the momentum and the price action. And that's and exclude most other things. Put those on your back burners so that you don't forget about risks that are building out there. But that doesn't always impact the market in the short run. In fact, a lot of the times it's very obvious. It's very obvious, especially when I've seen the bull side get out of hand with things. It's very obvious that they're getting out of hand for a long time before you finally get the crack in the markets. The market really gets ahead of itself. I think it gets ahead of itself in both directions personally, but mainly I've seen it on the bull side because my career coincides with Greenspan and all the following Fed, all the following Fed money printers, helicopter pilots, all the rest of them. So I've seen more or less mainly easy money conditions for the 3 decades I've been involved in the markets. But anyway, I just don't see it. I don't see a lot of stocks acting well. The sector review that we'll do later today, I think, will also confirm that, just like it did last week. I'm not saying that things can improve. I'm just saying the people that are making that argument right now that this is better, they're finding, I think, things that they can point to that instead of just kind of being objective. I think they're kind of, it's kind of like the selection bias type of thing. Here, this proves my point. Everyone, I guess, does that to a certain extent, but the bottom line is that a lot of things I look at, I would say on balance, it's just not there. If you look at a lot of different things, it's just not there. So they can carry on as much as they want. That's irrelevant in a way, but it doesn't change how I think we're going to view it. And I will talk more about the bottom line when I get down there in terms of the planned program for the week. And I just would note here that the debt ceiling, again, that was kind of the nothing burger. We kind of ignored it for most of the time. I did mention it this week in Rebel Pit Pro newsletter when I wrote that summary. And then I of course, mentioned it last weekend's videos here and there in some of the weekly webinars we do to support the services. But, again, it was all the same old story. It was just the same old nothing burger. And in the end, the country loses. That's that one constant. Regardless of what DC puppet play at theaters are in control ostensibly, you still end up with a really poorly managed situation that no household could sustain in their wildest dreams, given the way the government handles fiscal matters, et cetera. Another whole soapbox thing I need to get off of. But now let's talk about the current assessment. and I may as well take care of this while I'm here. And so this kind of relates to a comment that's in the current assessment section of the, hopefully the screen cap you got. But basically, what I'm getting to is that I use the ASAE on the third line down. Data new reports continue to reveal more of what we've been concerned about: stagflation talk rising. Fed may not ease ASAE by, I don't know why I might have had a typo or a problem on the cut and paste. So I think it could have, or it could have been by many, as soon as expected is what I'm getting at there, by many. Maybe I just meant to finish it that way. But the bottom line on this, of course, is that you can look right here and you can see, right, the current target rate is here. The markets are pricing in, as of right now, they're pricing in that we have a greater chance, I would say a significantly greater chance, of going up another 25 basis points. And so where this pause is supposed to come in is not really manifesting itself in the markets just yet. A lot of people had us ending the rate increase cycle already, and we'd be potentially on our way down, even at this meeting, believe it or not, that's occurring in about 2 weeks. But that doesn't seem to be playing out at this moment in time. In fact, if you go a little bit further out in time, you can see that if we take this possibility, it's almost balanced against the current, where we are currently, that possibility. But if we take these two together, you know, we're well into the 70s. And so you're at nearly, right, you're at nearly a 3/4 of a chance that you're at least here, if not higher, in July. So that, to me, that delays things, right? Because then you still have to wait at least a couple, 2 months there, right? You have to get through the whole CNBC luxuriating in Jackson Hole, probably in August, I think that is, if you can stomach it. But anyway, if you get through July, and this does in fact occur, you know, unless there's an emergency Fed rate cut, which is rare, I wouldn't expect that, but you never know. It depends on the circumstances, I guess. But I mean, you're waiting at least 2 months to potentially start coming down from here, should we go there. So I don't know if that's really, I don't know if that's really what's going to happen, of course, but I also don't know if people are paying attention to this enough right now. So that's where I'm at on it. I mean, that's, to me, why one of the things I'm talking about is that I still think that these guys, as usual, are getting ahead of themselves. So just to recap, right, the presidential cycle that we've been talking about really all year long, for the most part, third year, the presidential cycle is still preserved. We've got that on target. We're in the sweet spot. There's a little bit of a discrepancy between how so many stocks that are really pulling this market along, the biggest of the big names that all of you are familiar with, that's June has typically not been a great month for a lot of those stocks over the last, let's say, 10 years, from what I've been able to gather. At the same time, the third year of the presidential cycle tends to ignore that and just keeps going until we reach that kind of mid-July-ish towards August area. So we have a little bit of, I guess, a conflict there, and we'll have to see what happens. It's not as if we're beholden to trading in accordance with the third year presidential cycle performance anyway, but it is a pretty decent, has proven itself so far this year, despite everything, right? I think this has been some of the absolute hokiest stuff I've seen since the late 90s, personally, maybe like 98, 99 range, where it started to get really silly, been kind of then beyond silly. I'm not saying that the AI thing doesn't turn into something really strong. I think it probably will, given if it has enough time to do that before we implode as a species. But bottom line is that I don't know if it all happens fast enough and fixes a lot of the problems that are out there. I just don't see how this may help companies' bottom lines, and that might be, of course, all the stock market cares about. But there's a lot of fallout from that seems to me to be, at the very least, to be concerning. But again, market, especially bulls, they'll buy first and ask questions later. And I'll reiterate that if you're just an early adopter and you buy into the hype early, you have a great chance to do very well, in my opinion, most of the time. The trick, of course, is not overstaying your welcome. And people that have been in our services, knowing the techniques that we really focus in on and really, I guess, beat the drum almost incessantly on, that should prevent you from getting smoked. You should still be able to play the game, so to speak, and then be able to continue to ride things without that kind of great fear that you could give all of your profits back in one fell swoop, sort of like a lot of people did that just couldn't understand what happened after March of 2000, I think it was. So the spiders did finish near the recent high, but the Dow and the IWM ETFs, that is, and we chart these as a reminder, we chart these because folks prefer these to the cash indexes because they like the fact that if there's something that we talk about here that catches their eye, that they can maybe trade off of certain levels or certain scenarios that we discuss. So that's one, if you're wondering why we don't focus on that, that's because and focus on these. That's the reason why. These are still lagging, as you can see, though, right? Both of those are lagging. So the strength rating is still still there. The only problem is, and I should cover this now, again, some of your heavy duty intraday charts, they are flashing very overbought levels, and usually these levels on these time frames do not last all that long. But remember, I think I've got in there, right, that we've got possible, right, we've got that euphoria potentially, right, where they're going to potentially, again, I don't know if this will happen, but they'll potentially be celebrating this this debt ceiling deal, right, the so-called deal in principle, whatever they're calling it. That could create, and if it does create this kind of initial burst, if you're still riding longs, I can't tell anyone what to do, and I'm not giving advice. I'm just saying what I would do if I were still riding longs is I would capture those profits on that burst higher on Tuesday morning, if that in fact does occur, and I'd worry about getting back in however I choose afterwards, right? Because I feel like once they do that, should they lift this market up by another % or 2, let's say, on some, maybe more squeezing, I think you'll be so overbought in the short run. It'll be, a very, like, I would call it a relatively rare occurrence, right, where you don't see across the board overboughtness. It'll really be mainly in the Qs, but there'll be so many stocks in there that'll be so overbought in the short term that I almost think that it's such a high probability they take at least a pause, if not experience some kind of pullback. That's just because they're starting at these are not individual stocks with stock specific news. I'm talking about the index at this point. They're just, this index ETF, they're just so overbought already in the Qs, in the SMH, things like that, that it's really hard for the entire group to continue to ascend, even if some of those components are still acting and partying like it's 1999. So there you go. That's kind of what I would do. But let's cover the fact that I'll mention things here without going into them. But I'll give you some short-term overbought readings already in place on what I would call the heavy-duty intraday timeframes, and they're mainly, again, in the Qs and SMH. But as an example, even in the SPY, you're into, on the 2-hour, you're near 64 already. So that would put you, probably, if you get this gap, right, that's going to put you with the new highs. It'll make a new recent high, maybe take out even these highs back here, and that'll maybe start to potentially close the gap. This is if that scenario unfolds. I have no idea if it will, just thinking it could. But you'll be stretched on the Bollingers. I put my Bollingers back to 2 standard deviations removed from the mean. I run a 100 mean. Anyway, these are pretty narrow right now, so I don't think it's the end of the world for bulls or at all. It's just that there should be at least a little respect for that, unless there's news that follows that up. IWM though, and the diamonds are nowhere near, right? You've only got, like, you've got on the 2-hour, for example, IWM is only at 52, right? So what I would think, and this is what this leads to, is, and diamonds we'll take a look at too, and they're at 51 rounded on the 2 hour. So that just gives you an idea. So I would think, right, if they're going to try to improve their lot, this is bulls, of course, that they might start coming for some of these left behind index ETFs, sector ETFs, and of course, individual stocks that comprise those. So you might want to look for things if this buying starts to fan out, because they feel like they've taken tech and the semis just about as far as they can take them. Now, we had a question come in about Abgo. This, I think, made a new all-time high on the NVIDIA news. And you would think, well, okay, they haven't even brought their earnings out yet. There you go. They haven't even brought their earnings out yet. So what's going on here? So I still think if you look at this, and I know that's a really simple way to go about it, but I think a lot of people that would dismiss this simple approach would be shocked at how this stuff matters, like literally years later. But in my opinion, it does anyway. But looking at this, right, I would say that this thing still could go. I mean, I have this thing potentially still going up even more. And I would say there's probably another kind of, like, let's just call it $20 maybe plus. And there's nothing that has to stop it there at that. That line looks odd there on the daily. I'm not sure why that's plotting that way, but there's definitely more room there if they want to take it. So I wouldn't expect this thing just to collapse. But the question came in, what do you think that could you have sort of another big reaction there? I think you could. I mean, I can't rule that out. It's just that I think a lot of that's got to be, you would think, right, a lot of that would be priced in by now. A lot of the good stuff that they see maybe carrying over from NVIDIA, that NVIDIA thing, I guess, is already getting priced in here. So it is what it is. And this is a good example of when you've got a catalyst, we may as well cover it while we're on it. When you've got a catalyst, and that I think was the pre-EPS run in NVIDIA, and then the announcement is also its own catalyst, and the reaction to that, of course. But this is why I'm not that worried about narrow bands, because when your Bollinger Bands are this narrow, because you've been not doing all that much, there's a lot of people look at it, excuse me, like there's a lot of stored energy that can really start to become, energy, essentially kinetic energy, right? Energy that's in motion or something in motion. And you get this strong move. I don't think, I would have anticipated that kind of, well, I mean, it's from where you break out, it's about 100 and I guess $70, something like that. So I wouldn't have necessarily thought that would happen that quickly, but these are the times that we're in. But anyway, that's, if you wonder why does this guy occasionally mention narrow and wide, that's the reason why. If the bands are really wide and then you're super stretched, I think that's far worse than when the bands are quite narrow, as they were, and you become this stretch. But still, regardless, you're really stretched. I think a lot of it's priced in. Can't say for sure. I mean, when you get into these situations, I've seen stocks, literally trading at 400, and analysts, this is back in the late 90s, an analyst says they think it should trade 800. By the end of the day, the stock traded 800. Things like that in my memory. So I don't rule a lot of things out as possibilities after witnessing what I saw there in the late 90s. Just things can get incredibly irrational and ridiculous, and beyond, I think, probably what 99% of people would expect. And that's probably stating it conservatively. So I just think your biggest issue is that you are in overbought in the Qs and the let me get the SMH numbers thrown at you quickly here. The SMH, say, on the 2 hour is at 82. On the 1 hour, it's at 85 on the RSI. On the 4 hour, it's at 80, almost 81 if you round it a little bit. So this is these are up there, right? Again, I'm not saying you should pick a fight with this, but I just think that you've got to take into consideration, right, that this kind of an ascent, the steepness of this ascent is probably not sustainable for long. The problem is you really don't want to pick a fight with these things while they're in this kind of a mode too soon. So that's why it's interesting and tempting, and there's gaps that could be filled, all kinds of things. But these things can get and stay stupid, as people like to call it, for a while. But that is extremely overbought. If Avgo adds to that, it'll just be probably one of the all-time extremes that I've seen. Like, I would say maybe, the most extreme stuff I think I can recall since the late 90s, which goes back a long way. So, but I mean, anything prior to, that subsequent to the 99 stuff, I don't think I've seen that kind of thing to that extent very often, but it is showing up in this sector ETF. So we talked about not easing as much as possible. As soon as expected. We also talked about the advance still being narrow. I'm not going to go into all the breadth on that. Let me just talk about this. Okay, yeah, AI driving the market performance this year. And that's the big question, right? Is this justified? My way of looking at it is when these kind of new things spring up, there's so much hype, and rarely is, in the short run, I should say, rarely does the hype was the hype justified. A lot of the times you get a real kind of, like, after this kind of a party, you get sort of a hangover effect. And once everyone buys into the hype, you all know what they do. And just go back and think about all the EV stocks that were running a couple of years ago, and things associated with crypto, and so many of the absurd prices that were out there, and how some stocks were just darlings, and they were, unfortunately, I can't recall all of them right now, but they had certain things that were just extremely, extremely high, nowhere close to what they'd be worth anytime soon. But again, the hype dominates in the short run, and reality probably has the final say in the long run. But that's what it is. So right now, the other things I think we should talk about are that there's a lot of things, I think, aiding this jam job that they've been able to put on the last couple of weeks. One of them, and a good reminder, is, right, that when you're in a consolidation, you never know for sure, but the odds-on bet is that you leave the consolidation in the same way that you came in, right? So if you had an uptrend coming into this, you should expect the uptrend to win. That's why I'm going to be doing some more about this, but that's why when you get this kind of a thing here, you don't know, like, hey, will they pull this thing back a little more? That's totally legitimate to trade that if you see it breaking down. But you also always have to keep, in my book, you have to keep in mind, right, that without a serious, let's say, macro news driver, you have to realize that this could be a false breakdown, because especially, right, if it's a breakdown inside of an uptrend, because it's a counter trend development. And so those are the low probability versus the high probability. Essentially, that's the low probability outcome relative to the trend continuing. And I think a lot of folks would agree that in the face of so many things, they still found a way, and they always do. That's the thing. Like, they always find a way until the trend is really changed. And so that's what you should keep in your mind. There's nothing wrong with saying, okay, this is breaking down, I'm getting involved. I think there's a little bit more. I'm going to roll towards the end of the day because it was a pretty decent drop, whatever the case may be. But then, look, when they start to work it back and hold it there, at some point, you've got to just say, like, yeah, this probably could be, maybe could be a false breakdown. Yeah, it's looking like it's a false breakdown, that kind of thing. So just kind of keep that in mind, because we came across that. But another thing that we should cover while we're here is this retracement. So I think at this point, if we go back, let me try to get 5 years, a 5-year view on this. But I think at this point, the whole move down that we saw, and the bottoms in October that we saw, that were, right there. So from this back to here, I think we're at a 61.8% retracement right now. So that's probably some big news, I would think, right? It kind of is big news. That could be a stopping point, it could at least be a resting point, right? Where there's this overdoneness and then maybe they reel it back in a little bit. So I don't want to guess what this is going to happen this week. I'm just saying that that is pretty significant. Another significant part of that is a lot of people are going to interpret that as, well, there's a real bullish story unfolding here, because, to get that much retracement of this whole down move that was basically the bear market, then that means the bulls are much, much closer to really grabbing control officially, right? And we're really on the verge of a new bull market. When people see this much retracement occur, that's telling them that the selling it was probably exhausted, and now there's a new bull market emerging. That's how a lot of people are going to look at it. I'm not one of them, but I'm just saying that you got to acknowledge that, and they could be right. The other side of it is they could be right. The spiders, I think, have already gotten to at least 50%, right? Yeah, they've gotten to 50% in terms of the retracement. So let's get that on here. And then there's our number right there. It's hard to see with all my stuff, I know, but there's your 50%. So they haven't quite gotten there. They would be near the level we've been talking about for a while, that 432-ish level. I've rounded it off to at this point. That's my level where the great trickery would come in potentially. So if they do kind of make sense and overdo a little bit beyond that fib retracement, that would dovetail with the way we've been looking at this high here. So I think you're getting the reasons for the jam job are that you're getting the gamma squeezes. That's part of it. You've got a lot of shorts. You've got terrible sentiment still, which of course is contrarian. A lot of folks are underinvested, playing catch up. So FOMO is coming back in. The YOLO crowd I can see is coming back in, because I see some little gambits in UOA where they're trying to force squeezes on rinky-dink names that are really struggling companies, but it doesn't really matter. You know how they can trade until they really meet with the Reaper. They can still trade way, way, way up. So there's also a lot of mechanical players, and by that I mean folks that basically, when certain market conditions flip, they'll go from bull to bear. So that's referred to as the CTA crowd. And they are, I think, also mechanical buying again. So they'll be chasing things the more they go up, if they haven't already, to a great extent. And then the short squeezing, that game is coming back a little bit. They're trying to really, I think, ramp that back up again. And so take it for what it's worth. I mean, that's usually in a bear market, from what I've seen, that's usually towards the end of a overdone speculative phase. But remember, if they really do get things rolling, they could punish a lot of people and effectively force more buying and more, I would say, dubious companies out there. And then that'll be interpreted by people that see things a certain way, perma bulls, in other words, as well. Look, they're coming after everything. And so I think a lot of this is not really people coming after everything because they think things are wonderful. I think there's a lot of reasons why this is happening right now. And I don't think it's really where people are connecting the dots and saying, yeah, the economy is going to be great and rates will be coming down soon, which ultimately I think is a lot more important than where some folks are positioned with long calls and on zero DTEs. That's my way of looking at it. Anyway, bottom line is stock market continues to ignore economic data conditions that are concerning. This is exactly why we always harp on the price action and momentum, right? This is why we do it in Rebel Pit. This is why we do this, what we do in the other services that are momentum based, mainly the UOA services, mainly UOA Pro in my case. It's just because this is what they can do. And so we are sort of the economic bears that are concerned, but ever since this happened and they started to get more constructive, we've been willing to go with it. I know some people still have trouble with this. I don't envy where you are. I feel bad for folks that have this issue. I've talked to people over the years and I understand it. It's very hard to kind of compartmentalize things to say, well, things are so bad, I just can't bring myself to buy stocks. But if you remember, right, talk yourself into it this way. If you feel like you're missing out on opportunities, say, look, you're not buying stock, you're buying options, you're buying calls, right? In calls already, right? If you buy calls, you can predefine your max risk. You can do this in a small way versus what you normally would do, right? There's position management techniques that can help you reduce your risk further and further and further. And remember, you're just renting the option. You're not in this like to try to take this longer dated, say 2025 leaps position, and you're committing to this and you're putting a bunch of capital on the line. It's really right, just embracing the fact that, like, look, for now, this is it. And so I've talked to some very successful people that are options players. They did pretty well at times, but they really actually sat out bull markets, entire bull markets. And I actually do understand where they were coming from on the fundamental basis and on the economic basis. And I'm kind of in sympathy with them that way. But I'm just saying that, right, ultimately, everyone that's looking at this is all about trying to do better for themselves, for their family. And you've got to be able to bring yourself to trade in both directions and just be opportunistic about it. And it's not easy. That's why I'm talking about it a little bit here. It's not easy when you really dig your heels in and your ego gets involved and you're saying this is absolutely ridiculous. And it is. If you ask me, a lot of what we see now is ridiculous, but you can still do very well, just trading in the short run. And again, if you're prudent, you're disciplined, you manage your positions well, even if there was bad news overnight, it would still be nothing compared to had you gone all in on the stock market with all of your capital, right, and own shares. So you got to keep that in mind. If you position size the right way and you're prudent, conservative, you can still do well. And making money even when you don't agree with the trend or whatever the case may be, the environment seems crazy to you, is better than missing out. And the only caveat I would say is if you're completely uncomfortable, definitely do not force trades, right? If you can't get over that hurdle, which I can understand, don't force your trades. But if you can sort of bring yourself to doing this, because we just don't know, right? I'm still a bear. I mean, in terms of the economic aspect of this, I still think rates appear to be going higher still. The pause isn't coming in when the gang tried to sell us, there'd be a pause. I think the economy is in worse condition already than I've seen so many downside revisions. I think a lot, and this is not against this current administration, so don't take this as a political thing. It's just every administration does this. This is why this country is in the state that it's in, because we have nothing but liars and obfuscators and con men managing our affairs. I mean, then it's been going on for decades. And it's all sleight of hand. I don't even know honestly, I don't think that these administrations that come and go even believe their own BS. I think they're just, this is the game. This is how they play the game. But I think things are a lot worse. There's bulls out there on, again, Twitter luminaries talking about how credit is being tapped and people aren't worried. I think it's the opposite. I think credit's being tapped out of necessity by a lot of people, unfortunately, already. So I could be dead wrong. I hope to be dead wrong, right? I hope we're on the beginning of a new AI-driven renaissance, and I'm looking forward to the H.G. Wells moments where I think it's the Molochs are serving me food, and I'm just sitting there enjoying music and a beautiful day. But of course, I'm not looking forward to that, but you get the idea. I just don't think that, given, right, the propensity for these megalomaniacs that run the world, run the country, run corporations, I don't know if it's really going to be everything's going to be in our best interest. I mean, the average guy, gal out there and their family when it comes to AI. But again, I could be dead wrong, hope to be dead wrong. I just think that the price action, the momentum is where you need to stay. I think it's overdone in these areas we've talked about. I think that you still have to go with the flow, right? So until you see some signs of reversals, don't get in and fight against this. It is definitely becoming toasty, at this point. And I just don't know. And maybe someone could help out in the webinars or the chats this week in terms of Where do we go if we do have the debt ceiling dopamine hit and that creates even more euphoria? How after that, what's going to sustain the high, right? What keeps the high going? And then let me just mention a few other things we haven't covered a lot lately, but one of those would be the dollar, and the dollar rising. I don't think this is a good development for stocks. Once again, I could be wrong. Once again, things change, but typically, right, we haven't seen the market do well for long when the dollar really gets chugging, right? And the dollar's trying to reverse trend. It hasn't yet, but it's trying. Hopefully, right, if you're a bull, hopefully this will start to back off a little bit more and we'll go from there. But if it doesn't, and this thing really starts to go, that would be concerning. It's already starting to get on my radar as a source of concern. It's not, I think it's overdone in the short run. Probably should pull back small at the very least. But that's just my take on it. But the yields, of course, have also had a little bit of giddy up and breakout. They really sliced through every SMA that Toucan Sam ever developed right there. So you've got to be on guard for the fact that this is not docile right now either. So you've got a couple things there that are concerning, and we'll take a look at the VIX and we'll kind of wrap up because I just have so much on my agenda today. I'm unfortunately, and that's why I didn't go deeper in browsers and things like that, browser tabs. But it's just the reality of the situation right now. So the VIX, right? This is tough one to chart, as I always say, tough one to chart like it's just another equity because it isn't. But this was interesting where they did start to move this thing up. But notice, right, where this ended. And so if we manage to kind of come, here's how I would look at this. If we manage to come back a little bit in the market and the VIX kind of holds its ground for a little while, but this overboughtness gets sort of, the overboughtness factor cools off a little bit, and you start to see the spiders do a little better relative to the Qs, the IWM and the diamonds start to pick up relative to the Qs and the spiders. If that starts to broaden out, right, this thing could very quickly be down further. I think the one thing that could help it, though, is that the fact that we were only about 2 weeks away from the next Fed rate decision. And so that could keep it a little buoyed relative to where it would go. After that, who knows, right? Because we don't know what happens at that meeting. But that's where what I'm thinking is that this thing could dawdle around a little while, but without this market completely cracking, I think it might just hang on and might inch up as you get towards the Fed. That would be really my best guess on what happens. But as of right now, like I don't think there's anything extraordinary there. Maybe you could say from a just purely technical price structure, even though I really don't want to venture there with this this symbol, I guess. You've got maybe your double bottom, you've got maybe you put a higher low in and you hold, and that's the first signs. We've seen higher lows that kind of tipped us off to the fact that maybe some things could begin to break out. We talked about those a couple weeks ago. I think Sim's giving me there it is. But this is what I was talking about right here. Let me try to. So right here is what I mean by that, right? You have this range and you didn't get down to the bottom points either there nor any of these. And so this was our first tip off, I think, that maybe something could brew a little bit different to the upside. And we talked about that way back when, just because they held, right? And just remember, it's kind of like, just like we're saying with the fib retracement right now, the fact that they were able to retrace this much is a concerning sign, I think, if you're a bear, because theoretically, right, if there's really this big bear market situation that's yet to unfold, and I still think there could be, but that you shouldn't really be able to work your way back. But again, these guys will kitchen sink it and then some before they're done, creating this kind of a scenario. And they've done a masterful job. It's getting a little more, I think, difficult to justify where the Qs and the SMH are, but that's why the AI thing is such a great, let's say, skirt for them to hide behind in what they're doing. And that's just because it's pretty hard to put numbers and quantify what AI could do at this point, right? Even probably the best guesses of the most informed, brightest people are unlikely to be dead on. You know, take for example our good friend Paul Krugman, who dismissed the internet as likely to be a fax, suffer the similar fate or something along those lines as a fax machine. So it's not that easy to do this stuff. There's people that I think that are just experts at it, and I think a lot of times some things just never meet the hype they expected, and sometimes things are a bigger deal than they expected. So it's kind of hard to really argue with, well, AI is going to do this, that, and the other thing for the bottom line. It very well may, right? It very well may. And so that's why this is a great cover story, because you really have to be super informed about something that's not easy to be super informed about, and then extrapolate all of that knowledge into and how that kind of trees out in the future. And that's not easy to do, you know. So this is it's a great piece of hype, right? It's a great hype headline that they can go back to until it stops working. So I would think that it's a copycat world out there, and I think everyone will try to do this. They'll try to sell the AI hype to get their stock prices up wherever they can. So I don't think that should surprise anyone. We've seen this kind of thing before. So that's what you've got to be prepared for. So anyway, I probably should end on that. Just some of the thoughts I've had going through my mind, something a little different this time around, just because, right, you're short-term overbought in these big areas that have been leading, and if they get through again, this euphoric thing that could develop on the opening, I still think you need to cool off in these areas we've talked about. See if the rest of the market starts to participate a little more, and if not, you know, again, to me, that's still not a good sign. And then you've got maybe where rates just continue to rise in their faces. Maybe that does start to have an impact before the Fed. Maybe it has an impact at the next Fed meeting. Don't know. But other than that, that's the biggest thing. Assuming the debt deal holds, becomes law, then assuming that holds, I don't know what else is out there besides, you know, geopolitics, the usual stuff that you really can't say much about. So once again, thanks to all the vets, past and present. Sincere thanks for their sacrifices, and I will wish everyone a good conclusion to their weekend. And we'll get started tomorrow morning with our 4-day week that we're going to be trading in here. So get ready. Hopefully it'll be 4 days of action, gives us some opportunities. So thanks for tuning in. I hope that something I share with you in this video helps you out this upcoming week or sometime in the future. Once again, thanks for tuning in.